Well, hello everyone, it's Shooter. We're going to go over the primary wave setup, just giving you a little bit more detail of the better ways to use it. Of course, at the end of our presentation, please do review our disclosures. Now, I want to start with a basic foundation of Elliott wave. And what Elliott wave really is a cycle program. So we're measuring the trough to the peak and to the trough again. Now, there are two types of Elliott wave patterns. There are motive waves and corrective patterns. With motive waves, there are three types of motive waves: an impulse wave, a leading diagonal, and an ending diagonal. Now, the corrective patterns are zigzags, double zigzag, double threes, flats, triple zigzags, triple threes, triangles. Looking at the wave patterns, you'll hear me mention multiple times throughout my work 3, 5s, and 8. Elliott wave likes 3, 5s, and 8s. Let me elaborate on that for you. Okay, first of all, wave 1, wave 3, and wave 5 are all motive waves. This entire leg, wave 1, 2, 3, 4, and 5, is also a motive wave. Now, we can have an impulse leg down and a corrective leg and another impulse. We can also have a 3, which is an ABC here, a 5 wave here, and a 3 here. Or we can also have a 3, 3, 3. So the corrective leg, even though it may have a different pattern, triple 3 or triple zigzag or double zigzag, etc., ultimately it still has a similar format to an ABC. So my 3, 5, and 8 is this. So 3 is wave 1, wave 3, and wave 5. The 5 is the whole impulse wave or motive wave to the upside, which is wave 1, 2, 3, 4, and 5. So that's your 3, 5, and my 8 is adding in the ABC. So wave A, wave B, and wave C. That's where I come up with that concept of 3, 5, 8. Just makes it simpler for me. So when I look at a chart, I'm always looking for a 3, 5, or 8 to manifest, and ultimately reversion to the mean will occur at some point to some degree. All right, so let's drill down just a little bit more, and that's as far as we'll go into Elliott wave. Now, wave 1 is either an impulse or a leading diagonal. The difference is wave 2 is deeper. It's broader than wave 4, all right, that in the leading diagonal. Now, wave 3 is an impulse. Now, there's the technical side of Elliott wave and the in practice side. Truthfully, it's finding what works for you that you recognize. So to me, wave 3 is always an impulse wave, and technically it's always an impulse wave. However, wave 1, in my experience, can also be an ending diagonal, and I've seen them. So there are outlier events. Now, wave 3 is typically an ABC. Now, the one thing about ABC patterns, this is what I refer to as equality, right? There's really 3 outcomes to a corrective leg in my book, right? That's not the technical side to Elliott wave, but this is my opinion of the chart, and this is how I trade it. And the reason is I need something that's simple for me. I don't need a PhD when I'm looking at every chart. I want it nice and easy where I can think really quick, make the decision based on what's there and run with it. So wave A in the corrective leg can either be an equal leg, an extended leg, or an elongated leg. Equality, which is 50% back of wave A, or it can also be extended, but that becomes more of a flat double zigzag kind of thing. So it's really not the ABC technically, all right? Then wave C can also be equality, an extended or elongated. Now, what often occurs is you get an extended A, sort of a shallow B, and a short C, or vice versa. You get a shallow A, right, an equal B, and then you get this either extended or elongated C. And, that's where I use the fib extensions to connect that. And I just devised a very basic format to Fibonacci extensions, and using an extension tool, not just a regular Fibonacci tool. Reason is because I can measure the cycle. So I can measure the trough, the peak, and the trough. Okay. So hopefully that was explanatory. So now, because corrective legs are very simple for me, I'm looking for 50% back. And by using trailing stops, if I only get the 382, it's going to take me out anyway if I've managed my stops correctly on the upside. But same thing can occur on the upside, on the downside. Each symbol has a demeanor. In other words, the buyers and sellers have a certain sentiment, unless they are at the point of FOMO, fear of missing out, and then they jump in and add positions, or FOL, fear of loss, and now they're freaking out. When fear of loss occurs is when you get that extension, especially on the wave down, and then this no longer is an ABC, or this is an impulse down. Let me switch gears here and use my Tesla stock analogy. And what I'm doing is I'm doing a comparison between the sentiment and momentum that's reflected in Elliott Wave so we can fully grasp the concept. Okay, first of all, this is a export lot for Tesla. Notice that we have a grouping of white cars and a grouping of black cars. There are only so many cars on that lot, okay? There's only so many black cars on that. There's only so many white cars on that lot. That technically is not going to change aggressively in a trading day, for my example. We're not going to see that car lot double today and sell all of those cars, all right? But the same case goes when, there are roughly 3.5 million Tesla owners worldwide today. There are only so many Tesla stock owners. And there are even fewer people who sell Tesla stock. Now, that is what Elliott Wave reflects, is it drills down and measures the number of people who become buyers and sellers of the stock. I realize you also have stockholders who bought the stock when they bought the car because they're total believers in Elon, and I don't disagree with them. But at the same time, there's still only so many people who are going to sell their stock. Okay. And then there's even fewer people who are going to trade options on that stock. So when we start seeing that buyer and seller FOMO and full fear of loss, because we're afraid we're going to lose our money, that emotion doesn't change with an Elliott wave. So let me jump over to my primary waves and just go through this review. First of all, I'm going to go back to the cycle, and just look at this real quickly. This is our base of our cycle. This is our trough, this is our peak, and this is our other trough. So we're trying to trade this leg. Now, when we look for a setup, we want a setup that is going to reflect seller exhaustion and buyer exhaustion. Now, what Elliott Wave actually does is it does this by the types of wave intersections and the wave degrees. Now, when we look at wave degrees, which is to the bottom center of your screen here, we have a lot of different size waves. And I look at it like boxes. They stack on top of each other. Picos are very small. They're not even on this chart. Right now, we have minute, minor, intermediate, and primary, and a cycle wave on this chart. All right. So the dark blue labels are cycles. The green labels are primary waves. The little lighter gray numbers above that is an intermediate wave. The blue wave is minor waves, and the pink waves are minute waves and sub-minute, etc., as they progress down the scale. So what I've learned over time is that this euphoria that we see, and I use different technical tools to measure that. Now, I use an HCL bar versus a regular candle, so because it reflects the close. And this is one tool that I learned from Dale Pinkert, just a little thing worth its weight in gold. The off number, which is the close of the candle for the day. You have a weekly off number, a daily off number, a monthly off number, obviously a quarterly off number, a yearly off number. And what I learned over time is it also revisits those numbers. So from that, I devised a method to look at resistance that reflects seller or buyer exhaustion and seller exhaustion and where those occurred. And I recognized over time that they occur to a different degree based on buyers and seller sentiment. Whenever we have a broader resistance band or a broader support band, obviously we had more euphoric sellers coming off and more euphoric buyers coming off, as an example. And then I recognized that matched up with our waves. And then I went back and started back testing everything. And I ultimately came up with, our primary wave setup. So we have a primary wave that occurs, right? We do not want to use, for example, an intermediate wave because it's not a primary wave, right? At the same time, we don't want to use a primary wave if there's not enough on the wave intersection. So there's not a lot of conviction with the different boxes, how Elliott wave timeframes stack on top of each other, because there's not a likelihood that that's great support. However, down here where we have 3 wave intersections, it is much more consistent than if we have a spot where we have 2 wave intersections. For example, we don't have a lot of conviction on this intermediate wave. We don't have a lot of conviction here. Over time, I learned that I was better off sticking with the primary wave because I got a better result from that when I traded, especially wave 3s off of a primary. Now, when I met Kirk, I sort of devised this plan because, I was like, hey, it's really hard for me to track and tell because basically if I follow all these charts and I'm telling you blow by blow what's going on in these charts, man, I'm spending 100 hours a week telling you guys about one chart. It was exaggerating, but the reality is it was a lot of work. So part of the reasons this format, because I was looking at charts, I wasn't really marking up charts to share them with anyone else, and then I devised this visual. So what I've done now at this point is the primary setup. So when I post a chart in primary waves, it has a primary wave setup. Now there are times it will have a 90-minute trigger, a daily trigger, or a weekly trigger, or there may be no trigger at all. Very often do I post those. Usually I wait till the next week. I'm tight enough in following the charts where I can see that. Basically, the concept here is that we want to scale in. And let me just break out a Bollinger Band with Fibonacci extensions to explain myself a little more. So now what you've seen me bring in is resistance and support, Elliott wave, now Bollinger Bands with Fibs. So I'm combining multiple technical tools because each of them give us a piece of information. Now, what I also learned over time is that when a stock is about ready to squeeze, it gets skinny. When a stock is about ready to come off, the Bollinger Bands get broad. Now, each of these bands are one standard deviation. So one standard deviation, two standard deviations, three standard deviations. And I also came to recognize that at points where we are typically beyond, so I prefer beyond a second standard deviation before I take a trade. I prefer a tag of a third standard deviation because if you go back and look at the tape, there's only so many times that occurs in a period of time. So that builds on my conviction. So now we've added in not just the look of Bollinger Bands with standard deviations, we've now added what basically is a trigger, all right? Now, on top of that, what I've done is I've brought in a strategy, which a standard SMA with a EMA deviation on there. So it measures standard deviations to some degree, and then it gives me an alert based on the time frame. So now we have a primary wave degree has occurred. Now we have a trigger that has occurred on the 90-minute. Now we have a push of the second standard deviation or third. So those are three key events for a primary wave setup. And now we're waiting for that alert to scale in. So now when I get the alert, hopefully I'm trying to get where I can create this alert for TradingView so you guys can just use it on your own charts. You can do it in MotiveWave. So if you sign up for MotiveWave and you're a rare member, I will send you a copy of that strategy so you can import it. If not, we're going to ask for a couple bucks for it. I'm not sure what. Literally, you're looking at a $20,000 strategy. As a matter of fact, I know a lot of people who've just spent $20,000 to $30,000 alone just learning Elliott Wave. A couple $100 for it's going to be cheap. Be very candid. And I probably won't ask that much. I'm just looking to offset my data costs and everything else that, right now I spend about 80% of what comes to me from fundamental trends just in applications I use and, software that I'm bringing in and data and everything else to run. So, but once we have those conditions in a row, now we're just waiting for our trigger. So our 90-minute triggers. And, the concept here is that we want to come in shallow because this is really cheap. Realize this breakout line is where the market buys. But a lot of the players in the market don't buy until they get a breakout. They're just not going to do it. I must say this. When you look at a standard deviation in the tape, there are times I will throw up a label that says second entry, third entry, etc. Very much, like I'm showing you now on my screen, right? And what I'm basically saying is I've come in, even though the Bollinger Bands with Fibs may not be visual on the chart. When I throw in a second entry there, I'm like, there's a very big likelihood that we might need to scale in further. So if we do the 90-minute, we get a pop and it gets rejected. At that point, we want to reevaluate the chart and make that final decision whether we're going to hold that or we're going to take it as our stop. What the primary wave setup likes to do is it likes to back test the setup. So quite often what we'll do is we'll get this breakout up here and then it'll come all the way the heck back down here. So, I do tighten up my stops a little bit in here, but now all we're really doing at this point on a week-to-week basis, when I post the chart, you'll notice that you'll see some charts that have a 90-minute trigger, some charts that have a daily trigger, some charts that have a weekly trigger, and some charts that have a breakout. So basically the concept is this. Let me review the concept. Go in with 0.25% of whatever your allocation percentage is when you get the 90-minute. add another 0.25% when you are a 1/4 when we have the daily figure that I publish. And then when we get the weekly trigger, you're adding another 1/4. Then we get the breakout, you're in a full position. Now your average in should be about 50% of that, so 43. So you still should be, about $17 in the money at that point, or $10 or $15, whatever it might be with a particular stock. So now we're looking to chase our target, ultimately target 3, which is up here. But we still have to ride this storm out because we know this leg is going to back test 50%. Now, see, this is where it gets difficult. From a position trader, this is very hard to watch. And which is one of the reasons I brought in my Tesla analogy, because we're our biggest enemy when it comes down to trading. Man, I struggle with it still today. I mean, I was in Tesla this morning. I was chasing 6750s, and then I was chasing 65s. And the reality is I made about 10 or 15% on both of those, and I was out because the market was so volatile, it'd take my stops out. So either you're brave enough to trade without stops, which means you're trading with a smaller position size, which I've done before. But I'll be honest with you, for me, it's kind of boring, unless I actually like having the risk on the table. It might sound foolish, but I do, because when I'm right and I get a 300%, it's very euphoric for me. I love that. That's what I really, truly enjoy out of trading, is when, hey, I turn $500 into $5,000. That I really enjoy. However, you can't do that every day. So part of it is your risk management. That's what I'm trying to explain here. So when I come in and say, hey, we have a primary wave short, what I'm basically telling you in the primary wave setup is that, hey, we're going to come off here and you should be assuming that we're going to go 50% back. I'm just saying here, when you look at this leg, every leg, we're looking for 50% back. Okay. This leg, we're looking for 50% back, every single leg. So from a management standpoint, are you better off? I guess it really depends on how much you want to work, because I'm not saying this is easy. It's a hell of a lot of work to really trade or invest. I mean, you're going to spend hundreds of hours in education using similar tools to what I'm suggesting here or something else. And then you need to understand when you're wrong. And that's basically what I'm saying here. I like to know for example, when I put in my lower high and another lower high, I'm probably trimming if I haven't trimmed already, or if my stops haven't taken me out. Now, quite often what I do is I like to do a trailing stop based on a percentage of my gain. And the reason is it's simple for my mind when I'm tired, because I'm tired a lot. Unfortunately, I have sleep apnea, and Jesus, sometimes I haven't slept at all. I mean, I may go weeks. But the point is, when I set a trailing stop, I don't have to go back and visit it. I'm done. My trade's over. Okay, if I made a profit, great. If I have a loss, great, because it means that I was right by putting the stop in place. So I like 5s, 10%, 15 or 20%. I typically don't run a trailing stop any deeper than that, except for at the start. I'm going to run a 50% trailing stop here because we're not even started yet. The reality is we could chop here for a while, and I don't want to get taken out. If I have all of these other conditions, I want to be in that trade. That's the risk reward to the upside is we're going from $28 to $87 on this chart when we're looking at DuPont. Okay. When I'm looking at this leg from this low at $49, we're looking to go to $109. So we're talking, 110% if we're just trading common shares, not using the leverage of options. So mastering this on any time frame is very valuable. Going back to the primary waves. So we have a primary wave setup that occurs after a downtrend. We have a primary wave trigger that occurs after an uptrend. But then I'll put another label over here and say, hey, we got a new primary wave setup. Then when we get a 90-minute trigger, I'm going to put it in here. I'll throw it in there, save it to the chart. Then when we get the daily trigger, I'll put it in there. And you're scaling back in again. I also have triggers for the downside. I'm not that aggressive in posting them in fundamental trends because we're really not a counter trend room. Even though, I'll be candid, I prefer to trade counter trend. Okay. So, at times you will see for example, a weekly trigger to the downside. Once in a while, I'll even post a monthly trigger. That's, so the whole, but it takes time to migrate this, because realize you're looking at a weekly chart. We're in conference in 2020 to 2023. So we're encompassing 3 years on this chart. How long did we wait from wave one at March 2020 to the next leg, January 11, 2021? So it was basically 8 months. Then from our next leg, that was January 21 to September of 22. So another year. So these are extensive time frames that we're looking at for these setups. Now, do primary waves work on the shorter time frame? Yeah, but I don't have as much conviction for anything outside of the weekly. The reason is the noise on the dailies, because sometimes I'm trading 1 minute. I only progress in time when my trades are working. My whole structure of trading is based on, hey, the trade works, the trade doesn't work. Okay. If I'm right 70% of the time, I'm adding to my position and how I'm scaling. If I'm wrong, less than 70% of the time, I'm not adding, I'm not doing anything. When I get below 50%, when I'm not right 50% of the time, I'm trimming everything. Next trade, I'm off, it hasn't won, it hasn't hit the market conditions deliver something to us, in what Elliott wave measures based on buyer and seller sentiments. And the primary wave setup is designed to help you target that. Now, the other things that you'll see on the chart, the primary wave labels are only going on primary wave or above. I will post them. And once in a while, I'll do blue ones for cycle waves, but honestly, there's too many labels. So you're probably going to see green labels until I get an assistant who can label my charts. Intermediate waves and minor waves, I'm just going to use a regular colored label to give you an idea of what the steps are. So when you see this, look, this is an intermediate wave, right? This is a minor wave, and this is a minute wave. And, at this point, you're going to see this label that marks wave 3 and wave 4, just to give you a visual of what's there. But that's roughly how the primary wave works. Just a quick recap. Primary wave setup, right? We wait for the 90-minute trigger, we add 0.25%. We wait for the daily trigger, add 0.25%. Wait for the weekly trigger, add 0.25%. Wait for the breakout, add the fourth and final position. Okay, now at that point, we have established a solid trailing stop based on the percentage of our gain. Whatever percentage your risk management want to use, that's what you've done. Now, as far as shorter time frames, again, I pretty much start off every trade with a 50% trailing stop. Okay. And at that point, I'm going to tighten it up as we get into the trade. By the time we've got the weekly trigger in, I'm not usually down to 20%, but I might be at 30%. All right. And at that point, because I want to retain my gains, because I'm confident enough in the strategy where I know if I get taken out, I can find another entry. All I have to do is wait for the back test or set up my alerts on a shorter time frame, and I'm there. So, but that's what we have for today, folks. I hope this was helpful. Please remember to like and share this, and reach out with any questions or comments that you might have. Other than that, folks, great trading. Until next time.